Hello there, traders. Welcome to the Markets in Free with me, Senior Market Analyst John. I am here to give you all the latest in FX markets and some key charts to watch to keep you updated on what is going on right now and what a few days it has been in FX markets. We've had some fresh volatility coming into the market because of the US and Iran escalations. And now we've got even more escalations coming potentially. So I'm taking a look at gold today. Gold is going to be back in the mix for us because there is a lot of geopolitical tensions around at the moment. So the reason why gold makes potential sense for some upside, first of all, it's down over 27% on the year so far, right? Which is a huge move down in gold. The second thing is, from a technical perspective, we've come back down into around about this $4,000 level and found some kind of support here recently on the weekly chart, right? Had a nice little kind of test in here, second test, third test, closed back as an inside candlestick last week. So if we do start to see breaks above this weekly high, then gold could start moving back to the upside, potentially back into the 4,800 level in here. Now, a couple of things keeping gold subdued at the moment. First one, bond yields. Bond yields in the US have increased, which means the increase of potential rate hikes in the future, or expectations of rate hikes in the future, has gone up. That is usually dollar positive, which obviously also brings gold prices down. So that's a couple of things that we have to be aware of. And if we go take a look at some of those bond yields, we can have a little look at the US 2-year, for instance, which is, the short end of the curve, which is what the Federal Reserve will be keeping a close eye on. That's trading at 4.2% at the moment. If I was just to compare the US interest rate to that on a new price scale, you can see that we are way above where current rates are, which is that 3.5%. So if this continues to climb, it could be a catalyst for the central bank to hike interest rates. If we look at history, what have we seen? We've seen that when the US 2-year starts to go and starts to get a little bit parabolic, for instance, we see that the US Federal Reserve starts to hike interest rates pretty aggressively. When we see that US 2-year is below the interest rate, what happens? We stay flat or we see decreases in the interest rate. And what did we have most recently? We had a cross back above the 50 moving average on the weekly chart, and price is starting to push higher, or bond yields are starting to push higher. So this is what I'm watching for. Now, for gold to turn around, really, we need to see a reversal in this, right? We need to see US 2-year yields coming back in line with interest rates. Now, there is potential for this to happen. Obviously, what we're seeing at the moment is the fact that the geopolitical tensions are holding US bond yields higher at the moment. But if we see that geopolitical tension move away and look behind the scenes at the data that we've seen out of the US recently, then there is a chance that we could see US yields a little bit lower. We had obviously a softer jobs report recently. CPI next week is a big catalyst for price, because if we see CPI headline coming in lower because oil prices have been lower recently, that is going to play a big role into how bond traders position themselves and how the markets look at interest rate expectations. If we think about as well going forward, core PCE, and that's something that the Federal Reserve take as their kind of tool that they like. Now that could change because we've had a new chairman, so what they look at, but really speaking, personal consumption is something that is what the Federal Reserve will be looking at. Are people spending their capital, right? What are they spending it on? If it's sort of more items that are less energy, less food, all this kind of stuff, but on other products, then that shows that there's demand in the economy. If that demand continues and is persistent, like we saw back in 2022, then inflation could rise. That means the Federal Reserve will have to act to try and cool the economy down, right? That's what they want to try and do. Now, Fed Walsh has been very vocal about bringing that side of the mandate down, right? He said that inflation is not within the target range, and that is something he's very serious on. So interest rates really are going to play a big hand into what happens into gold. If we take a look at what's going on with gold prices, though, we're at this weekly support level. And then today, of all days, we've seen some geopolitical tension between Ukraine and Russia start kicking off. But if we just take a look at it from a chart point of view, we've had what's known as the death cross, right? That is when the 50 moving average on the daily chart crosses over the 200. Now, I tried to have a little look back in history of when this last happened, and we have to go a way back. The last time that we saw this death cross was around about the 6th of October 2023. Now, if we look at what actually happened to price, yeah, look, we're in a downward trend. The market was making lower lows and lower highs. But as soon as we had that kind of death cross come in, price rallied. Price then closed above that on the 16th of October and then continued to rally. And that led to the big move that we saw in the markets. If we have a little look at the previous time it happened, it was in 2022. Now, this time, because it was an inflation story and we saw inflation rise significantly, we did see gold prices drop. And it did continue for at least 5 months after the cross of the 50 and the 200 moving average. So we have to be careful that, we have to understand what market this is in right now. And it is that inflation story, but it's more of a supply shock inflation. It's not necessarily a demand inflation, right? So I'm looking at this as potential for, some little bit of upside maybe, or maybe just a little bit of sideways price action. Let's bring on the adjustable profile. Okay, let me see if I've added in my new one. Yes, okay. So let's just have a look at the past kind of couple of months worth of data, right? Let's do this one. And then let's move this one like this. Okay. Now, what is this kind of telling me? In fact, I don't really need this one on here. What is this really telling me? If we have a look at the profile of last month's market profile, we can see that price has come back and traded within last month's value area low, which is around about that $4,000 level, and retested it and is holding it. So really speaking, when you look at market profile, we can see that when price opens up within value, a lot of the times it can stay within value, right? So I can see from here, there's a potential for maybe that gold wants to trade back to the other side of value. Where is that? That is at those highs here that formed around about the 16th, 17th of June of 2026, and is that kind of $4,350 area. So this is a significant chart of interest. Now, like I said, we need a few catalysts to really drive gold higher. And that's what I'm looking for on a day-to-day basis. We did report sort of earlier in the week that 80% of traders are long gold, retail traders. And that usually means we do see some downside, and we have seen downside this week. But, looking at kind of current sort of weekly profile, again, we've kind of climbed back up within value and is holding now above that 4,000 sort of $100 area. So gold is actually starting to show some signs of life to the upside, because we are seeing a little bit of dollar weakness in the markets right now. So, for me, when I'm looking at this chart of the market profile, I can see the value area low is currently trading around about 4,094. If we do see price kind of push back into that level and hold, it could act as support, which pushes price up to the next level or value area high. Now, we are on Thursday, so likelihood of this just, rallying up to that level could be quite low. But as a potential trade idea, it's something that I'm definitely looking into on gold at the moment. If we break back below the value area, that could mean that we're breaking out of value again, and the market could try and trade back to the downside. So let's move on to the big story then. And what I've been kind of speaking about is I did not mean to press that button there. I meant to press this one. Checking out the big story then. What is the big story? Now, obviously, the US-Iran war is a huge, huge story within the markets. But we've had some other news as well. So we've had some decent coverage of Ukraine and Russia recently, which has obviously kind of bubbled in the background. But apparently now there are going to be a reason to escalate. So we saw Ukraine attack Russia oil refineries recently with some success, and also seen some bombing of other areas as well. Now, we've just had a report coming from News Squawk saying that the Russian President Putin is reportedly likely to escalate the Ukraine war. According to sources close to the Kremlin, high probability of escalation in coming months could extend beyond Ukraine's borders and into NATO-aligned Baltic states. Now, that is a huge escalation, because that means that if it expands out of Ukraine, NATO could get involved. So that means the US, Britain, France, all European countries that are signed up to NATO may have to get involved in this war, which obviously nobody really wants, right? The US in particular would not want this, because US President Trump has a very good relationship with Vladimir Putin, probably better than he has with President Zelensky. So that is a thing that we need to keep our eye on in the market, because that could be something that escalates further. We also saw overnight that US struck around 90 Iranian military targets. So again, bubbling of escalation in there. CNN also reported that the US President Trump is losing patience with the pace of negotiations, right? But then has also come out and said that, again, Iran want to make a deal. He's kind of going back and forth on what he's saying right now. And I think what he's trying to do essentially is control what's going on in the oil market. Now, if we just go take a look at what's happening in oil markets, we can see that we were bullish pretty much all of this week. Right, the market has rallied from the lows of $68 to the highs of nearly $80, and we started to see a little bit of a pullback in today's proceedings. But again, what has happened is price has come back into a strong level of demand. So if I just bring on a market profile tool again, we can see that if I just take the market profile of yesterday's trading action, right, the market has come down into this consolidation here and found support, right? So it's come right up into this value area high of sort of the Asia to London session of yesterday, and has reacted, and we've started to see a little bit of a bounce higher, right? So market is bullish. It's telling us that it's kind of trying to price in this risk of what's happening in the market, and we're starting to see oil prices reflect that. Oil price moving, at least or nearly $20 in price. So we're starting to see that being priced in here. We're not really seeing it priced across stock markets, although stock markets yesterday did fall. So if you look at the S&P 500, when it was announced that the US and Iran were in conflict again, we dropped from 7,500 all the way down into 74.30. So there was a significant drop in the stock market, but pretty much in the US session, the market recovered that. It's recovered it. And, we're pretty much trading pre-open levels of yesterday. So, the stock market isn't really, it felt the risk premium, but has quickly priced it out. And that could be down to the fact that obviously the market is potentially pricing the fact that the US Federal Reserve might not hike interest rates, but that's all going to depend on upcoming data. So the big story really is we're starting to see geopolitical tensions rise. How will that impact the likes of gold? How will that impact the likes of the US stock market and even oil prices going forward? Let's move on to the skill of the day. So the skill of the day today is talking about retail trading sentiment. Okay. Now, there's a few ways that you can find this. First of all, I have retail sentiment in my terminal here, right? Or you can have a look at my FX book, right? So my FX book do a market sentiment reading, right? And this is powered by Awanda. And what it shows us is where retail traders are positioning themselves in the market. Let me just zoom in for you so you can see it in a little bit more detail. So you can see here what we have is the symbol, right? We have the community trends, shorts versus longs. So that is amount of traders short versus longs. The popularity of that symbol, so how popular that is at the moment, how much volume is in that. Average short price distance from the price, right? Average long price distance from the price, and current price. Okay, so that's average longs, what their average long position is. So that's 115.42, offside by 113 pips. Average short price, how far they're offside. Now, the way that I like to use this is by looking at extremes. So let's take a look at pound yen, for instance, right? We can see that pound yen, it shows us that 83% of traders within this data are short, right? There are, in terms of volume, 1,244 lots, and there's 3,712 positions. On the long side, we have 17%, 251 lots, 1,194. Okay. So what that tells me is that retail are heavily short pound yen right now. And if I scroll down to this section here, this shows you the price versus the positions. So if I just go to a daily chart and I change the chart type to positions at the bottom, what you'll notice is as retail traders add to their short position, so this red line on the bottom of the screen, and decrease their long positions, the green line at the bottom, look what happens to daily price. It moves higher, right? So the correlation is that when retail traders start aggressively getting short in the market, then the likelihood is that price is going to do the opposite, unfortunately. And that could be down to a multitude of reasons. It can be down to the fact that a lot of the times retail traders try and pick the tops of trends or try and call the bottoms of trends. So in this case, pound yen has been up. If I just like zoom out on this weekly chart, on this daily chart, sorry, we can see that price has gone from lows around about that sort of, what was that, 207s, all the way up into sort of the 220s, 216s or whatever. So we can see that they get aggressively short, and there's a couple of notions that we can look through here. Look at the start of April. At the start of April, we actually saw them get heavily long, decrease those short positions, and price was bearish, right? If we look at where it kind of swapped over here, they got aggressively short, decreased their long positions middle of April, and then the market went north considerably before we saw a little bit of intervention chatter, market dropped. But since that intervention chatter, they've been fairly flat until now, where we've started to see an increase in those short positions from the retail traders. And look what happened to price action. Now, obviously, you could look at this information and on a week-to-week basis and say to yourself, well, if retail traders are getting long, then I want to be, if they're shorting yen or shorting pound yen aggressively, I want to be long that market and look for those continuation patterns. You can look at it in a different way. Sometimes when their positions become so extreme, they flip their positions. So, for instance, here they were aggressively short, but they flipped positions aggressively at that point, and we saw short positions drop dramatically, long positions increase. And actually, if we look what happened to price, then we did see a little bit of upside. But that's not them getting aggressively long. That's just getting rid of their short positions. And then look what happened. We did see a huge drop in price. But I like to look at when they're gradually increasing those positions in the market. How does that reflect price? Another example of this is we spoke about this a few weeks ago. We actually looked at dollar CAD. It was a pretty popular chart to trade a few weeks ago, and we actually talked about it just before the end of June, right? And look at what the positions were doing then. So the reason why I highlighted it is because short positions were increasing, long positions were decreasing, and we were at like a point of resistance, right? This 138 handle. And I discussed this saying, well, actually, this could be a good idea for us to buy the breakout and try and seek at least one spot for. What happened since then was much greater than that. The market broke out of that 138 handle, broke 140 number, and went up to 142. And look at the short positions from the retail traders. They continue to increase those short positions, even though dollar CAD was in an upward trend. And they're doing this because they're trying to pick the top of the market. They think that that market has to reverse because price is too high. That's not how markets work. There is a saying in markets where markets can be irrational longer than you can stay solvent. And that is what's happening in most of these cases. So you can use retail sentiment to trade, or at least give you some trade ideas of what to look for in the markets. I highly suggest looking at it. Obviously, this needs to be taken in with other context as well. You can't just use it on its own. But, you know, if you were looking at sort of comparing it with currency strength meter, for instance, which told you that dollar was strong, CAD was weak, and then you saw that retail traders were heavily short that market, then, you know, it makes sense to go long, right? So try and combine all those different factors together when you're making trading decisions. So I'm going to leave it there. Thank you for joining me today. If you did like this stream, like and subscribe, and I will catch you in the next one.